Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 29th, 2025. I am Luna.
I am JPMorgan.
In today's deep dive, we're really digging into the financial headlines from August 28th. We're looking at that interesting Goldilocks mix as, strong growth, but also these dovish Fed signals. And of course, keeping an eye on those lurking wildcards. Think of this as your JPMorgan and Luna daily 5-minute briefing on what really moved markets yesterday.
Yeah, it's fascinating, isn't it, how the markets are trying to navigate this. You've got an economy showing surprising resilience, but at the same time, there are these signals popping up that might just push the Fed to act, maybe sooner than some think. It's a very delicate balance, maybe even contradictory, really.
And you could definitely see that optimism in the markets yesterday. U.S. equities were up, S&P 500, Dow Jones, both closing at record highs, tech leading the charge again. So this Goldilocks scenario, it seems like robust economic data plus hopes for lower rates that really fueled things. But what makes this Goldilocks maybe a bit fragile?
Well, first, the good news, right? Q2 GDP growth was revised even higher, a strong plus 3.3%. That shows really solid consumer spending, good business investment, great for corporate revenue prospects, no doubt, but the fragility. It comes from the market pricing in those Fed rate cuts so aggressively. Even with this strong growth, it implies this very, very delicate dance. Any misstep, in the upcoming data or how the Fed communicates, that could unravel the optimism pretty fast.
Right. So strong growth, okay, but the labor market numbers, they hinted at something different, maybe, a subtle shift. Weekly jobless claims came in a little below what people expected, 229,000. Continuing claims fell too. So layoffs are low, but hiring seems to have slowed down quite a bit. Is that enough to justify betting so hard on rate cuts?
Well, it suggests what some are calling a stagnant labor market. It's not collapsing, thankfully, but it is cooling off around the edges. And that does give the Fed some crucial leeway, room to maneuver, to consider easing policy. In fact, we actually saw Fed Governor Waller, who's usually seen as a hawk on inflation trade. He publicly argued for starting interest rate cuts in September. Now, the markets, they're pricing in about an 85% chance of that happening. That dramatically shifted expectations. Short-term Treasury yields tumbled, the dollar weakened. Getting that kind of signal from a known hawk, well, that's significant.
That really is a powerful signal from Waller. But speaking of the Fed, wow, the institution itself made headlines for a very different reason yesterday. Reminds us that not everything moving markets is purely economic, right? This is where it got really interesting. We saw this unprecedented confrontation. Fed Governor Lisa Cook actually filed a lawsuit to block President Trump's attempt to fire her. I mean, what does that kind of internal challenge, that political drama, mean for the Fed and for the markets?
Oh, absolutely. This immediately introduced what we call a political risk premium into the markets. Basically, investors started demanding higher returns because of this new uncertainty, this political interference. You could see it pretty clearly. The U.S. dollar weakened and longer-term Treasury yields actually went up. Why? Concerns about the Fed's credibility, its independence, and maybe potential future inflation if political interference keeps up. I mean, this direct challenge to the Fed's independence, it's almost unheard of in modern times. It could genuinely lead to a sort of structural repricing of U.S. assets long-term if people start thinking its autonomy is eroding.
Wow. Okay, so domestic political risks adding pressure. And then on top of that, global events kept stirring the pot too. More of those lurking wildcards. Geopolitics flared up again. Russia launched a huge missile and drone strike on Kyiv. That helped support oil prices.
Indeed. And plus, we also got news that Russia's Ust-Luga oil export terminal is going to operate at only about half capacity in September, apparently due to pipeline damage. That cuts something like 350,000 barrels per day from the market. So oil prices jumped initially on that supply jolt, quite a surge. But then some of those gains faded back. Demand concerns started to creep in, like, the end of the summer driving season in the U.S. It was almost like the market had a quick oops moment on supply fears, then remembered the demand side. But the underlying risk from that disruption, it's still there.
Okay, so putting this all together, what does it mean for you, the listener, as we look ahead? What should you really be watching in the next few days?
Well, the big one, the marquee event, is definitely the U.S. employment report for August. That's coming out this Friday, September 5th. This report is hugely influential for Fed policy. It's one of the last major pieces of data they'll see before their September meeting. Expectations right now are for fairly modest job gains, maybe 75,000 to 100,000 jobs added, and maybe a small tick up in the unemployment rate.
So if the report comes in weaker than that, does that basically lock in those September rate cut bets we talked about? But what if it surprises on the upside, strong job growth? Could that just derail this whole narrative?
Precisely, yeah. A weaker report would certainly cement that current dovish thinking, makes the case for a cut much stronger. But if we get a surprisingly strong number, that could absolutely challenge the market's conviction right now. It might push back those rate cut expectations, and you'd likely see some significant volatility. So yes, it's a definite must-watch.
We'll also be keeping an eye on the Fed's Beige Book. That's out September 3rd. It gives more anecdotal clues on economic conditions across the country. And the ISM Manufacturing PMI on September 2nd gives us an early read on factory activity.
Wow. It really feels like walking a tightrope, doesn't it? You've got record high stocks on one side, fueled by strong data and the hope of Fed cuts. And then on the other side, you have these geopolitical shocks and just unprecedented political interference drama with the Fed itself.
It's exactly. This Goldilocks scenario, good growth, easing price pressures, Fed support potentially coming. It feels like a potentially fragile equilibrium. It's like threading a needle wearing boxing gloves, maybe. A very delicate maneuver. And that crucial upcoming data, especially that jobs report on Friday, could easily just reset the market's direction entirely. So it raises this really important question for all of us, I think. Is the market's current optimism truly justified by the fundamentals, or are we just seeing a sort of short-term, maybe lucky confluence of factors that could dissipate really quickly, leaving investors scrambling for a whole new story?
Definitely something to keep in mind as we head into the rest of the week and into next week. Thanks for joining us for this deep dive. You've seen the headlines, but what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts, and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai. Know what moves your money.